welcome to the 7th edition of Our Take. My name is Michelle Kessel-Harbart and I'm here with Ken Brown, and today we are going to talk about yield. We have a fair amount of clients that depend on their portfolios for income, and with interest rates at historical low levels, where do you turn? So we've traditionally turned to municipal bonds, certificates of deposit, or to a lesser extent, corporate bonds. So let's take a look at some current yields. As of June 18th, the current yield for the 1-year Treasury bill was 0.17%, the 90-day Treasury bill 0.14%, the U.S. 3-year Treasury index 0.23%, and the 1 to 3-year California Municipal Bond Index 0.64%. After inflation and after tax, there's functionally nothing there. Unless interest rates go negative, which we don't project, there seems little opportunity for positive returns. Ken, let's talk about how we're helping our clients maintain an income stream from their portfolio in a low interest rate environment.
One ground rule is that in doing this, we have to make a commitment. If we were going to make a commitment, for example, to go into a 3-year CD or a 3-year municipal bond or a 3-year corporate bond, then I believe that this commitment should be an equal length and perhaps even a little bit longer to experience more of the market cycle, the upward market cycle, especially coming out of this recessionary period that we're in. So that's number one. Number two, we have to be willing to withstand market volatility. And that's very difficult for fixed income minded people. It really plays with the psyche. And of course, one of the negatives of the stock market in general is that people can look up a quote anytime, any place, and basically see if they're making or losing money, again, which plays havoc with their psyche. So we have to be able to, again, make this commitment, look beyond the day-to-day machinations in the markets. I guess, basically in putting this together, not be greedy. It's easy to try to reach for the higher yields, but as we've discussed in prior videos, oftentimes those yields are subject to cuts and declines, and we don't want to be put in that position. So I guess if we have those ground rules in place, we can move forward.
So let's talk about specifically what have we done for our clients, some of the things we've done.
In cases where it's appropriate, for our clients, and with this understanding in place, we've taken a percentage of assets that would otherwise be allocated for fixed income and moved them over into income derived from equity. In other words, derived from stock. And this essentially means that if they had a 60-40 portfolio before, which was 60% allocated for stock and 40% allocated for bonds, that part of that 40% is going to go over into a equity income, specifically income, underlying income portfolio.
Right. So one thing to keep in mind is obviously with what we're looking at here, there is risk, right? So there is risk. We're changing their asset allocation. We're taking some out of that fixed income piece, which is traditionally low risk, putting it into an equity piece, not the entire fixed income allocation, but a piece of that. So it is adding some risk. So what are we doing to mitigate that risk?
Well, let's first of all, sort of try to classify what that risk is. It's mainly volatility risk. And again, that goes back to looking at the stock quotes on a day-to-day, week-to-week, month-to-month basis, and having an emotional reaction to those. So it's that volatility risk. We've seen an awful lot of that recently. We expect that to continue. And that's why we said that we really need to focus on a 3 to 5 year time frame in order for this to essentially play out. So some other ways that we can mitigate some risks, and there's actually several, so I'm gonna resort to reading some of these, but one is we need to have adequate dividend coverage. That means that on a net profit basis, that we need to have approximately 1/3 to no more than 1/2 of our net income go towards the dividend. That's where we'd like to see it. We'd like to see a history of dividend growth. We're not looking for dividend growth in 2020, obviously because of this pandemic and the financial crisis that we're currently experiencing, and for that matter 2021 as we begin to recover and come out of this. We like to invest in leadership companies that are at the very finest quality, but also have great brands selling across the globe. We also are invested strictly in large cap US based companies, but again multinationals that sell to virtually into every continent. We like to have sector diversification, and we do maintain that. There are some sectors we don't want to participate in for dividends. One would be banks. Second would be energy-oil. A third would be real estate investment trusts, REITs, for various reasons. Of the three, banks have a history of cutting dividends during very difficult times. We like to stay with companies that offer qualified dividends. And again, these are all the companies that will be invested in. Large cap US based companies will have qualified dividends, which means that the investor will get a tax break, which means that basically they're going to be taxed at capital gains rates.
That's great. So, we've done a lot of research. We've taken a really close look at the numbers and looking at how we can put together some of these companies for our clients that will provide basically an equity dividend component, a portfolio, if you will. And so what we have found when we're looking at, for comparison purposes, in our research, is that we're getting around a current yield of around 3%. So obviously much better than the yields we spoke about at the beginning of our video. Relatively low correlation risk as compared to the S&P 500, because again, we want to compare this to an equity rather than fixed income. We have lower beta than the S&P 500. And when you look at the back testing, there's a lower drawdown. So during those times of a decrease in the market, whether it be most recent decrease in the market or whether it be back in the 2008-2009 timeframe, these companies performed much better than overall
in the down markets.
In the down markets, exactly. So again, mitigating that risk, right?
Great.
And then also we look at the Sharpe ratio, and the Sharpe ratio is a measurement of volatility, and we compare that to the S&P 500. And these companies also have performed much better with that indication as well.
So not quite half the volatility of the S&P 500, right, but somewhere around 60% of the volatility of the S&P 500, within that range.
Exactly.
Yeah.
Exactly.
Risk and caution today, but obviously, again, given the macroeconomic environment that we're living through now, I think it warrants talking about. If the dividends within this portfolio were reduced by as much as 30%, which is a possibility for a variety of reasons, but it could be anything, political, what have you. If that were the case, then this portfolio would still yield 2%. 2%, again, as Michelle just pointed out, 2% versus virtually nothing. So that's not the end of the world. The other thing to keep in mind, we mentioned this preferable tax rate, and I just want to make clear that the tax structure could always change. So that's not necessarily written in stone from this point forward. But today, for today's investors, for 2020, it's still very much intact. Okay. So for those of us with either very high levels of cash, which again is earning virtually nothing, or we have calls, redemptions for some of our fixed income portfolio. We have money coming in. This may be a reasonably good alternative for those of us, with the right mindset. So, having said that, I think that's all we have for today. So,
Great.
thank
So
you.
if you have any questions, or if you'd like to discuss this in greater detail, please by all means give us a call. Thank you so much. Take care.
Thanks.